looks like it's something, if it looks like it's something that we need to address closer to the end, I'll address it at the end. So don't hesitate to throw those questions in though, and we will certainly do our best to get to them. Now, let's go to the real good stuff here. Hopefully good stuff. The market is actually setting up some pretty explosive opportunities right now that I'm starting to see. And so I wanted to address that immediately because, I mean, many of you probably noticed when you were signing up, we had, one of these sort of setups even last week in 3D. DDD is the symbol, and the trade right now is already up over 130%. It's continuing to go our way. These are the kind of setups that get me really excited because when I can find returns of 100%, 200%, sometimes 100% or more. I mean, I've had trades that go 1,000% or more. They don't happen every day. They don't happen every week. They don't happen every month. But when they do happen, it's a great time to pounce. So I'm seeing some of that stuff set up now. And I wanted to talk to you guys about how I identify that setup so that I can try to leverage it really well with hyper focus on the markets for the next probably couple of weeks as we go through some of these setups. Before I do, here are my disclosures because lawyers say I have to. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. So even though I'm going to be talking about, down to the actual fine points of specific trade ideas that I'm looking at, you guys need to do your own due diligence, speak to your own financial advisor before you make any decisions. This is just for educational purposes. So you understand what I'm seeing that makes me think there could be returns of 400% or more sitting out there in the market right now with good enough odds of success that I'm willing to make some bets here on that. For those of you that don't know me, this is me, Keith Harwood. Got I always write Keith Harwood MBA. I don't know why. I mean, but I got my MBA from the University of Chicago a few years back with honors in analytic finance, statistics and econometrics, and entrepreneurship. So to put it kind of specifically, basically really good statistics, math, finance, analytics background. That's generally been the way that I approach the markets, is to take a very heavy math focus and then try to convert it back to something that can be communicated to normal people, because mathematicians aren't so good at communicating with normal people all the time. I started in the pits of the CBOE back in 2005, traded through the subprime crisis. So I'm betting there are probably people in this room that might have even been born after the subprime crisis. But many of you lived through it, watched it, dealt with the markets during it. Many of you have just enjoyed the run in the markets since, with some hiccups here and there. Last year when we first started into this whole COVID situation, that created a nice hiccup in the market. But all of those hiccups are opportunities. And when we don't have hiccups, there are still opportunities. And that's what I've generally built my career upon, is trying to find the opportunity when it presents itself, whether it's because of a hiccup or for something else. I went off floor a few years after I started in the pits, started trading basically every product you could think of. I traded European fixed income options. I traded gold options and silver options. We had a pretty good size trading portfolio in gold and silver during quantitative easing, when gold was making its highs. Maybe not so crazy as what Bitcoin's doing now, but back in the day, that was the way that people tried to play inflation. So gold and silver was a very attractive commodity to trade. Once I finished my MBA at the University of Chicago, I moved over to a hedge fund, and I traded their precious metals book, as well as basically structured every options trade we did. So whether it was the grains traders or the soft commodity traders like sugar and cocoa and things like that, I structured the options trades for them given the bias that we had. And overall, I think we did really, really well, particularly in like oil and corn and soybeans and all these crazy things. But at the end of the day, that wasn't that rewarding to me, because basically I was helping billionaires become multi-billionaires. That's, not going to move the dial for them, even though they might be adding an extra billion behind their name. More important to me was trying to come back and find the people that frankly, as a market maker, we take advantage of, and that's the retail trader. The market makers are best suited trading with people that are in this room, self-included, not with people that are working for Goldman Sachs and working for Citadel and working for these high budget research trading facilities. We are operating at a completely different level than the professionals, but we can still take advantage of them by outthinking and outsmarting them and taking advantage of the fact that they have to move so much money that they often miss the nuance. The nuance is where we as retail traders make our money, and that's what I'm focused on now, is trying to figure out ways for us retail traders to take advantage of a mispricing in the market generated by the fact that people are trying to trade billions or millions and billions of dollars instead of hundreds of dollars. If you have to leave early, here is all my contact information, my email at the top, my phone number second, and be sure to watch your email inbox for an email from webinars@optionhotline.com. You'll get a free giveaway from me from Option Hotline. That's my trade checklist. It's basically my process for setting up trades like we're doing today. Of course, it's better to walk through the process today before you just look at that, because there's a lot of nuance to that checklist itself. So what I want to discuss today is originally the trend trading setups I'm looking at, because that's part of what creates this potential major leveraged event we're seeing. The swing trading setups that I'm looking at, which is where I actually implement the major leverage trades that I'm seeing. I always talk about why I use options and why volatility matters. This is an important element of it. We will talk through how that leverage exists in this current setup. And then I'm going to talk about what I'm focusing on for swing and technical trading, but frankly, it's mostly going to be swing trading. There's three really good sectors I'm looking at right now that have amazing leveraged swing trades setting up right now. And we'll do those at the very end. And then of course, Q&A as needed. So I hope everybody's excited. I hope everybody's got their thinking caps on, because we've got a lot of technical stuff to talk through. So the one key trend following signal that I'm going to talk about today is the simple moving average. For those of you that were on before we started, Steve mentioned my 5 indicators for trading success. This is one of those 5 indicators. I only really have time to address one, but I need to address this one because this one is crucial given the current market setup. So what a simple moving average is it takes the average closing price over a recent period. So if you hear people talking about the 20-day simple moving average a lot, that's just taking the closing price over the last 20 trading days, 4 weeks, roughly a month, averaging it. Now, if the stock price is above the average trading price for the last 20 days, based on the close, it tends to be bullish. We tend to think that that asset class has great upside because it's telling me that the momentum is positive. So when we're above the 20-day moving average, anybody that bought the close every day for the last 20 days, just kind of piecemealing in their portfolio, is making money. Anybody that's been selling over the last 20 days is seeing their account go red. They don't like that. I always like momentum trading and trend trading to follow who's making money. That's what I'm trying to establish when I see simple moving averages. Are current prices above simple moving averages? If the answer is yes, then that time period person is making money. So let's just look at the S&P 500 right now and address the simple moving averages that I use. In purple, we have the 10-day moving average. We're above that. Green is the 20-day moving average. We're above that. Blue is 50, yellow is 100, red is 200. You can see that the longer term moving averages are much below current prices. The 200-day moving average has always been a really important support point when we have a major liquidation like we had last summer, or basically every year or so we have one of those events, it seems like these days. That is 10% away. We are well above it. Everybody, every time horizon on a moving average would say we are bullish. Being above these levels is key. When you're dealing with individual equities, you will find many that are below the 200-day moving average, even though we have this major overall bull market. Part of what creates that is the fact that some companies just aren't doing that well right now, even as we start to reopen the economy. So we don't all have everything bullish. We do have the S&P 500 looking pretty darn bullish because prices are above every moving average, whether you're a short-term trader, 10-day moving average, or a long-term trader, 200-day moving average. What I use to enter, oops, I went one too far, to enter my trend stock trades is a triple moving average. So I take three numbers. It's actually not the 10, 20, 50, 100, and 200. I'll get to the numbers here in a moment, but I take three moving averages. If the shortest term is above the medium term, is above the long term, and the current stock price is above the shortest term, that's very bullish to me. Why? It means short-term momentum is stronger than medium-term momentum is stronger than long-term momentum, and current prices are also above all three, meaning everybody that's buying is making money. So momentum is going my way, and the long, the bull, the guy that owns the stock is profiting. And that's where I look at the S&P 500 right now, because this is a crucial one. We've just gotten back above the 22-day moving average here in purple just a couple days ago. There was some chop there. So that was a mixed signal for me. Once we got back above the 22-day moving average, which is above the 89-day moving average, which is above that 148-day moving average, it told me that overall, the bull trend still wants to work. Okay? So the bull trend wants to work, and the trend guy can make some money, usually buying either the stock, and I'll talk about a little more of the specifics why in a little bit, or an in-the-money call. Trending portfolios tend to perform better with in-the-money options than out of the money. And again, I'll explain why in maybe 10 or 15 slides. But the key here is that we're above all of these levels, which means my first of 5 indicators for trading success tells me I'm looking for opportunities to buy the overall market in the S&P 500. This may not be the case if you look at other sectors such as small caps or tech. Tech's been underperforming recently. The Dow Jones, there's only 30 stocks in the Dow Jones. It's a little harder for it to always be bullish. The S&P 500, the broad market, is bullish again as of less than a week ago. So I'm excited about the S&P 500 just off of that. But the swing trade is that much more explosive for the S&P 500 given the current setup, and I'll show you why in a moment here. First, Steve mentioned at the beginning, for those that were on before the webinar, and I mentioned it a few times here, I have 5 indicators that I use for trading success. This was one of them. I'm not going to spend any more time on the trend trading indicators for success because, frankly, the other opportunity for this week or two is that much more exciting to me that I want to focus our time on that. But if you want to know more about the trend trading indicators for success, make sure you click on this, what do you want to call it, banner. It's pretty much everywhere on the site. If you're watching this via replay, it should be just to the right of your video clip. If you go on the site anywhere, you're going to see links to the 5 indicators for trading success. If you don't see it, go to the top bar, membership, and you'll find it. So this can help you out with those other 4 indicators. For now, the key indicator for me is the moving average. So that's why we talked about that one today. Now let's switch over to the swing trading setups because those are the explosive ones. The swing trading setups tend to be more explosive, but lower probability. But what we're seeing right now is a possibility that we have a perfect storm of high probability due to the trend trading signals that we're seeing, along with that explosive setup thanks to cheap implied volatility and cheap options. Like this is great. This is what I love to trade for. This is what I live for in trading. A higher than 50% probability with explosive leverage, great. The market right now is consolidating, and if it can break out, there's a massive amount of leverage. This is all about trading for new highs where we have little to no resistance. You looked at the chart on the S&P 500. We'll pull it up again here. There is no resistance. For those of you that are familiar at all with resistance levels, resistance comes from previous prices that we sold off from. Well, the last price that we sold off from was on May 7th. SPY hit a high of $422.81. It's currently trading $419.07. So we're $3 and was that 74 cents away from all-time highs in the S&P 500. That is under 1%. We're talking about 0.75% move. Today we had about 1/3% move in the S&P. Each of these bigger bars, they're well over 1%. When we get a percent move, and that can set up the next 5% move right afterwards, that is what I'm looking for in terms of explosive return profiles. And really what we're looking at right now in the S&P 500 is a triangle. And this is my favorite consolidating swing trading setup. There is little or no resistance when the stock breaks out of the range. What we see here is as the lows rise and the highs stay close to the same, which is what we're doing right now. What everybody is doing right now in this market is saying, well, when we touch those highs right around where we're at right now, we tend to just go back down. So I can sell. Well, guess what? If we go above that, not only did we now create new, what do we call it, blue sky breakout range, we've also created a scenario where all those people that were selling oftentimes chase to get back into the market or buy back their short positions. When you have a tight range, people tend to try to scalp the market. They go short at current levels, they go long at the bottom, and they start doing well when that range is big. And then as the range gets tighter and tighter, they either have to increase their position size or just accept that they're not going to make that much money. Well, guess what? Nobody really likes to accept that they're not going to make that much money. So everybody increases their position size. People get more short at the highs, they get more long at the lows. And then all of a sudden you go to a new high. All these people that are shorter than they're normally comfortable with, they have bearish positions, are losing money. And generally speaking, right now, people that were bearish down here have already lost money too. People that were bearish here have already lost money. And then you get this major level of resistance that existed that finally gets breached. Finally, we exhausted the seller. And now we've created not only a lack of sellers, but an infusion of buyers. Creates an explosive move in the market. This is exactly how the S&P 500 is setting up right now. This is exactly why I'm looking at this type of setup for major, major potential returns. If the setup fails, where is the support though? Frankly, it's harder to tell in a triangle than some others because we know that the buyer has been increasing their price that they're willing to buy, but we don't know whether this level or this level or this level is where they would buy. This is where I actually take my statistics background and start calculating odds. I'll show you a graph of standard deviations here in a moment, but I take math to find my support level because my support level is my exit if this doesn't go right. Because my support level may be 1% down and I can take an exit, save my capital, and set up for the next time something like this happens. Because if it doesn't happen now, it may happen in 2 weeks or 4 weeks or 6 weeks. It's probably going to happen soon based upon the way I'm looking at the market, but it's not guaranteed to happen anytime soon because that's just how math works, unfortunately. If anything was guaranteed, it would never be an opportunity for us to take advantage of. Now, if the stock is a clear breakout, where's my resistance? When I look at the resistance right now, it is currently at the previous highs, May 7th, 422.81. We get above that, there's again no obvious resistance. So again, I have to start using standard deviations. I start using statistics and math to try to calculate where we might go. For those of you unfamiliar with standard deviations, this is a graph of a normal distribution. If you assume that a stock is normally going to trade right around where it is, there is a 34% chance that it trades between that level and 1 standard deviation higher. That's what a standard deviation is. It's the odds of basically trading in the range. 2 out of 3 days, we're going to stay within 1 standard deviation of current prices. So when you look at a move and say, yeah, today we only moved up 1%, tomorrow we moved down 1%, the next day we move up 3%. Well, 2 out of 3 days, we stayed within 1% of current prices. What the market's telling me right now is that the S&P should trade within a little over 0.75% of its current price 2 out of every 3 days. Now, all but 1 day out of the month, you should trade within 2 standard deviations, and that's just double the move. So 0.75% up was 1 standard deviation, so we're looking at 1.5% move to the upside or downside. We're going to trade within that band 21 out of 22 trading days, or pretty close to it. Every once in a while, you get a 3 standard deviation move, and it happens more often than the math says it should, because frankly, we've had like 10 standard deviation moves, and those are supposed to only happen once in a lifetime. And I've lived a lot of lifetimes in the last few years because we've had them. So normal distribution isn't perfect, but it's a pretty good estimation of what's going to happen 2 out of 3 days, or even 21 out of 22 days in a month. Not a bad way to do our math work. Because then we can start to say that if I think that we're more often than not going to stay within 1 standard deviation of my current price, I can set that as a pretty good stop loss. If we get below 1 standard deviation, it starts to get scary. Plus, if I'm in options, I'm paying for leverage that's not really working in my favor. It's actually going the other way. So I set my stop loss saying, okay, well, if we go down more than 1 standard deviation over the course of that month, which I can calculate using a bunch of math, if it goes down, it tells me I was wrong. And if it goes down that much, it tells me I should get out. And if it goes down less than that, maybe I can hang out for a little bit or reevaluate the charts. But for now, my initial stop loss is for a 1 standard deviation down move. And I start with the stop loss because risk is the most important part of trading. If you don't evaluate your risk appropriately, you will never find your profit appropriately, because you will burn all of your cash on bad trades. Poor risk management blows out traders, not poor profit management. Poor profit management will not leverage your account the right way, but poor risk management gets you out of the game. And then speaking of profit management, that's my profit target. I use a standard deviation over my time horizon as my target. 2 standard deviations in a single day is a day where I may look to book profits. I don't always do it because sometimes we get crazy moves, particularly in this market. I mean, I mentioned triple D at the beginning of the day. That a 1 day expected move is about 5%. Today, the stock's up about 10%, just under. If I followed this exclusively, I would have probably exited today. But based upon the overall market formation, I'm going to let it run and use what's called a trailing stop, where if the stock starts to pull back and shows me that today was the ultimate part of the move, then I want to get out. But otherwise, I want to let this run and let my winner run. That is the key to trading. It's letting your winners run and cutting your losers short, making sure you don't let those losers always kill you. So again, we're looking at the standard deviations, and this is the normal distribution. What I'm thinking is setting up right now with this triangle is that we either go up or down. So this is the market assumption, always. Something like this. It's a little different. If there's a little bit of a skew to it, it would actually look a little more like this if I were to draw it. Let's see if I can get this right. Is saying that you are going to go up and there's a smaller move to the upside more likely, but you have bigger downside risk. So most likely you actually go up. Still average move is 0. So you have an average expected move a little up, and you have a cap to the upside that you're probably never going to go above. And in practice, that's really what normally happens with the market. But when you have a setup like this, what I'm looking for to happen is this kind of distribution. So what the heck am I looking at? I'm basically saying we're not going to stay here. We're either going to go back down about a standard deviation, or we're going to go up probably closer to 2 standard deviations. We're going to get either a big up move or a small down move. When the market's at highs, options get cheaper, just the nature of the game. So if I think that we have a chance greater than 50% of a decent size up move versus a smaller odd occurrence of a small down move, I have leverage. I'll draw it here on this S&P 500 chart. What I am looking for is either this, and I'll make it a little smaller scale because probably 440, or this. And right now, the downside I'm thinking about is this 50-day moving average, because this is a moving average that has provided support from my trend trading analysis. Well, the 50-day moving average right now is $408. So we are talking about a not 14, sorry. We only have $11 of downside in my risk as the 50-day moving average. So $11, that's under 3% downside. If we start getting above new highs, I'm looking at that potential for a $20 upside. So about 5% on the upside. So if I have 3% to the downside, 5% to the upside, I have leverage, especially if I have greater than 50% odds of success on the upside. So that's how I'm approaching this market, is saying a move to 440 is well within reason. Over the course of a month, if we move 1 standard deviation, that would be about 4%. In this market, 4% of $400 is $16. So we're talking about if we break out above that high of 422.81, it gets us right there at 440. There's leverage there. So that's why I can find an opportunity here, because I can see support that's actually closer than 1 standard deviation away. And I can see a potential for 1 standard deviation to the upside or more if and when this market starts to break out. And you can see a little bit of this triangle formation that I was talking about. Right like that and right like that. So maybe I made this part a little long, but you can see it's really coming even tighter than that, honestly, more like this. And we're right at that precipice, right at that point. When you coil the spring, you got to move. So when you coil that spring too much, it creates this pressure in the market that is ready to go. And that's what we're at. We're at a boiling point. We're at a pressure point. We're ready to move. Now, if you want more setups like this in individual names, I want you to take a look. You're going to get an email about this. Keith's Outlier Watch List. I take individual names in the NASDAQ for trend trading portfolios. And I take individual names in the entire broad market for swing trading opportunities like this, like the triple D call I picked up last week that I said is up, 130 something percent, I think it was, as of the close today. And we'll see where it goes tomorrow. My average profit on winning trades is over 200%, because sometimes I only make 100%. Sometimes I get that 400 or 500%. I think that's probably a pretty good return overall on swing trading candidates. And then on top of that, the trend trading candidates, which are higher probability trades in general, average over 160% profit on the open trades. So you can see a lot of potential here if you're looking for candidates like what we're seeing right now, like what we've seen all the time, those swing trading candidates that can really be explosive when you time it right, and those trend trading candidates that actually perform a lot, many days of the year, because trends tend to just kind of go with the flow. And those are really good day-to-day, grind out good profits, but still generate major profits by using options. All right. I am going to take a quick break. If Steve can give me one moment to grab a glass of water, and then we will talk about the options stuff here and the specific trades I'm looking at today.
Excellent, Keith. Enjoy your couple of sips of water, and I will simply reiterate that as our count has continued to go up, we are almost in record territory for a number of participants or attendees. So thank you, everyone, for joining us. We are so happy when we see big numbers. So thank you everyone who has joined us today. And just to once again let you know that just for attending, you'll be receiving Keith's option trading checklist. Many of us use checklists in lots of different parts of our lives. And when you're trading real money, Keith's option trading checklist is a great thing to have at your side. Also, we are featuring one of Keith's products today, as he told you, and I'm going to tell you again, his 5 indicators for trading success. And also you're seeing on your screen right now, Keith's Outlier Watch List. These are both products that are available from Keith. If you go on the Option Hotline website and you go under memberships along the top tabs and you see memberships, there's a drop down and you have a number of different choices in that drop down. If you just look at the one that simply says Keith Harwood, and that'll have many of his products, including both that I just mentioned, Keith's Outlier Watch List and his 5 indicators for trading success. And these are excellent products. We ask you to take a look at them, consider them, and you might want to consider picking those up. And again, once more, everyone who is on with us right now, who has joined us today, will receive Keith's option trading checklist. Look for that in your email tomorrow. So Keith, are you rehydrated?
There we go.
Okay.
I hope so. And if not, I'll hydrate at the end. I know I tend to talk fast and I try to go through a lot of content because I want to give you guys the most I can. Sometimes that means I need to take a sip of water. Otherwise, I'll burn the back of my throat just talking. So thank you for that, Steve. I appreciate the short break.
You bet.
One note here, just if you want that outlier watch list, it's just a very simple link here at the bottom. You can go to optionhotline.com/outlier. That should get you access. It's $97 per quarter. So we're talking about $1 a day to get you all of these kind of ideas and the setups. If you're comfortable then executing your own ideas, once you get a little bit of guidance, it can really help leverage your trade returns as well, of course. Now, that said, let's go to options, because options is where we have our leverage and our risk. So I always tell people about these risks because risk management is the most important part of trading. As I've said before, transaction costs tend to be higher in options. This is because they are leverage, and that means they're taking more risk. Your brokerage firm is taking a little bit more risk when you're executing them. They have to charge a little higher commissions to make sure that they are compensated for it. So keep that in mind. But that should be offset by our game plan and our execution. Otherwise, we're wasting our time trading options, of course. Number 2 is assignment risk. Short option positions can be assigned. I am not discussing short options today because I don't like short options positions via short webinars like what we've got today. There's a lot of value to trading options on the short side, but trying to cover all of the nuanced risks with them in a half an hour or 40 minutes is never going to happen. Short options blow out accounts. We've seen it before. We'll see it again. I prefer to look for ways to get leverage for you guys via long option positions that actually a lot of people don't like to talk about, because frankly, most people like to talk about selling options as a way to generate income. As a result of buying options and what we're talking about today, there is that increased risk of decay. Options decay in value over time. They are insurance contracts. Insurance contracts with a finite time frame. And the ones we're talking about today, generally speaking, 30 days, maybe less. So if in 30 days, my scenario doesn't pay out, I lose my premium. And every day that scenario doesn't pay out, my options get a little cheaper. So I lose a little bit of money. It's not great, but at the same point, we can see a lot of that leverage side of it if I'm right about volatility as well as price direction. Volatility is partially dictated by implied volatility. For those of you that are familiar with the Black-Scholes model, implied volatility is probably the most important input because everything else is basically given by the market. Implied volatility is what we are estimating because it's expected future movement, not directional movement, total movement, percentage movement of that asset. It's constantly changing as money flow goes in and out of options. So this is the big one for options market makers, proprietary traders, etc. If you are using options for a technical trade, it can be a little less important. But if you are using it for a technical trade to get leverage, i.e. a swing trade, it's that much more important. We'll talk about that now. This is the standard why I use option stock. Many of you have heard it before. I always try to change up a little bit of the conversation, of course, so please make sure you still listen in on this. May learn something new. I might come up with something randomly new that I didn't even realize I was going to come up with while we're talking. So if I have a $100 stock and I buy $10,000 worth of stock, 100 shares, I have unlimited upside and my downside is the amount of money I paid. If I think I'm going to get out of the stock if it goes below $90, then I can cap my risk at $1,000 in theory. In practice, that's not always possible. If you don't believe me, look at Viacom, VIAC. The chart of Viacom looked bullish and then one day collapsed. It's not always possible to get out at your stop loss price. So please always understand that even if you think you're setting a reasonable amount of risk of, say, 10% of your trade, it's not always possible to execute that exit, especially if you're coming up on an event like earnings. Earnings can make a stock gap. So if I'm worried about that gap down or think that the upside is even better, then I can start looking at a call. A call gives me the right but not the obligation to buy a stock at a set price at or before expiration. So let's say I'm looking at June 18th expiration, which is, what's that, 23 days from today? A little over 3 weeks. Now, if I think that my stock is going to rise 20% in the next 3 weeks, and the call options are priced at $5, it means that in exchange for me giving away $500, because a call represents 100 shares of stock, I can now own the stock if it's above $100 at the end of my term on June 18th. Now, if I'm willing to risk that same $1,000 I talked about with a stock position, I can buy 2 of these calls, which means I can control 200 shares of stock on the upside and cap my risk to the downside. If the stock goes to zero, I only lose my initial $1,000. If the stock has earnings and it goes down, I only lose my initial $1,000. I don't make as much money if the stock only goes to, say, $105 because I paid $1,000 for my position and I need it to go above 105 for me just to break even. So I need leverage to the upside. I need something setting me up for an upside move, perhaps a technical setup for swing trading, like a triangle. If I think there's an explosive leveraged move, that's where I want to call instead of a stock position. Because if we have, whoops, I accidentally clicked twice. If we only have a smaller up move or a small down move, options don't do anything for me. I can buy 2 calls to represent 200 shares and start making money above $110. Great, but I got to get that move. I need that move over 110. If I don't think there's a high probability of a big move in the next month, then why would I waste my time with options? I don't want to waste my time when I think a stock's not going to move. Right now, I think stocks are going to move. That's why I want options right now. Further, volatility matters. Implied volatility is that price point. It's telling me how much the market thinks we're going to move. Right now, the market is telling me they don't think stocks are going to move. And I disagree. I think stocks are about to move. I may be wrong. I'm wrong 45% of the time. But if I'm right 55% of the time and my profits are 106 160 or 204% when I'm right and less than 100% when I'm wrong, I'm going to make a living doing this. And so that's what I do now is I look at the comparative values of if I think implied volatility is too low. When implied volatility is too low, we're looking at things like this. We are looking at implied volatility lower than where I think it should be. It creates a situation where the options are priced lower than they should be. So if I think implied volatility should be 36%, or if I think implied volatility right now should probably be closer to 42%, in this scenario on the high side. In fact, I think we're going to move a lot more than normal. Then I'm getting a discount because the market is telling me, no, Keith, you're wrong. We're not going to move. Historically, I'm right more than I'm wrong. So I'm going to take that bet and say, fine, I think we're going to move more than normal. You think we're going to move less than normal, and I'm going to get my call options for $1.97 instead of $3.51 that I think they should be fairly priced at. I'm going to get out of the money options for a 28% discount. I am going to further than that, 57% discount because we're going up to the 42% implied volatility. I am going to buy 5 options for the price that I should have paid for 3. So I get 170% of the leverage I was expecting. If I was completely unaware of implied volatility, I'd be better off trading in the money options. That's why a lot of people that you probably have heard always talk about saying, let's only use in the money options. You know why? Because there's lower volatility risk. There's less risk to implied volatility moving against you. There's also less leverage. You're getting a 15%, 17% discount. When you look at the chart of these payouts, you're literally just kind of buying the stock, but you're doing it with options. So you're just buying it for diversification, which is fine. That's great. If you are confident in your technical trade and your trend trade, I absolutely agree that using an in-the-money call works. In fact, I have programs that do just that. That's my trend trading program, is to say I am so confident in the trend that I'm just going to use an in-the-money option and not worry about volatility risk. But when I see an opportunity like now, where we see a swing trade leveraged move, I don't want to use an in-the-money call. I want to use an out-of-the-money call and really get my leverage. Let's look at the VIX with this. I mean, the VIX is the ultimate key here. The VIX is at lows, clicked one too many times, of the last 6 months. A week and a half ago, it was at the highs of the last 3 months. Not quite to the highs of the February, March area, but pretty close. Options have gotten significantly cheaper in the last week and a half, just as the market is setting up this potential crazy move. Why? Because over the last week and a half, we didn't move that much. We drifted higher. We didn't collapse. So everybody said, hey, I'm just going to give away options. You can have free calls, free puts, whatever. So whether you are bearish, which I'm not, or bullish, which I am, you can get cheap leverage right now relative to history. That's a good thing, because when I look at what happens when options get cheap is I start to see this green line, not the stuff here, this green line here. Look at the numbers, look at the relative basis. We'll zoom in. When options are cheap and I start using out of the money options to generate my leverage, I can do 3 times as well as stock. In my base case scenario here, we're moved to 120. Yes, I need a bigger move for it to work. But guess what? I'm seeing that big move. So I have a pair here right now. I see a big move coming up from the market, and I see cheap options. Then why wouldn't I look for some key leverage in out of the money calls instead of just trying to replicate a stock position by using an in the money call? Remember that $94 call I said, which is more of a trend trading portfolio? Yeah. It's great because it defines my risk to the downside and it allows me to have cash to use in other portfolio or in other trades. But the green line is the one that gets me explosive returns in this one amazing trade. Instead of making $2,000 on a move to 120, I make $6,000. When options are expensive, like they were 2 weeks ago, it didn't exist. because my leverage was to $3,000, not $6,000, half as much leverage. And I had to give up all of that upside in case the stock market didn't rise fast and far. So why would I waste my time with that if I didn't have cheap options? I needed cheap options. I've got cheap options now. I've got them. I've got cheap options and an explosive potential market move. So what I do with trending markets, again, as I go back towards those $94 type calls in my $100 stock, I'm looking for something that meets my triple moving average system. I'm like 3, 4, 5 months to expiration, 70 delta in the money. It's kind of stock replacement. Just gives me some extra cash in order to leverage the trade and start leveraging other trades. When I see a swing trade like I do right now, I am looking for 1 month to expiration or less. And I'm doing 30 delta options. 30 delta options are like those 106 calls in that $100 stock. They're out of the money calls, expecting an explosive move to the upside. Before I show you the ones, I want to reiterate, this is what I outlined in my outlier watch list. So those swing trading candidates are those 30 delta calls, those explosive potential moves. The trend trading candidates are those in the money calls, like the 94 calls. So just a reminder of what we're dealing with as you look at the outlier watch list. My swing trading candidates are always out of the money explosive return profiles. Like I said, I mean, DDD, just because it was a trade from last week, it's literally 1 week into this trade. The calls went from $1.05 to $2.50. So for every $105 you put into that trade, the profit right now would be $142.50, I guess, because it's $247.50. This is $97 a quarter. You do the math. $142.50 of profit in a week versus $97 for 3 months. And then the trend trading candidates that we're dealing with are obviously bigger trades, oftentimes $1,000 or $2,000 of risk, average of 160% profit on open trades. So, I mean, there's nothing to sneeze at there. Here are the trades themselves, and I'm going to give you the specifics, but again, I need to reiterate that these are for educational and information purposes only, because frankly, I'm giving you a little more information than I normally do on these ideas. These are the specific ideas I would be looking at in my portfolio as soon as we break out of these triangles. S&P 500 is right there. It's about to go up. If we go above the May 7th high of $422.81, I will circle the date. You can see it. It's kind of marked off there. We get above that level, I'm looking to buy 30 delta calls because I think that we could move, like I said, 4%. If I buy the $425 call, which is my 4%, my 30 delta call, playing for a 4% move to $440, this call has to be worth at least $15 if we're at 440. It's currently worth $2.34. On a rally of 1% in the S&P, this call is probably trading closer to maybe $3.50, but you can see the major leverage if it can be worth $15 and I'm paying $3.50. $350 investment to return back to me $1,500 when we reach my price objective. That's huge leverage. That's that 400% type return I'm talking about. I can do it again. Brazil. I mean, maybe this isn't on your radar, maybe it is. But if I look at the high of May 10th, we'll use an arrow this time. Once I find my drawing tool, there it is. If I use the high of May 10th right here, and we get above that, I think this stock, given the implied volatility, could go well over $40, maybe even to $41. Now, if I think a stock could go to $41, I just need to make sure that my parameters look good in the options. My 30 delta call right now is a 38.5. If I'm getting into that a little bit above where we're at right now, so say maybe it's a 70-cent option when I finally get in, I'm still thinking that can go to $2.50. So it's a triple, maybe almost a quadruple. That's a pretty darn good return for 3 to 4 weeks. But here's the big one to me. We talked the S&P 500, which, I mean, to see that kind of leverage in the S&P 500, pretty crazy, actually. You don't normally see that kind of leverage in the big indices. Brazil, it kind of makes some sense. But again, you're not always seeing these kind of leverage in the big indices. And now here is another big index that looks crazy ready to move, and that's financials. And it's even better to me because the risk is so much more defined. The downside here is to the 20-day moving average, right below where we're at. This coil is ready to go. If we break out, I can very easily see a 4 or 5% move in financials quickly. When we broke out at the middle to end of April, financials moved from sub 36 to a peak of $38.26. So just about $2.50. If we repeat that $2.50 kind of move in an index that normally doesn't move, you can see the implied volatility. Oh, you can't actually see it on this one, but oh, yes, you can, of 16%. We're basically saying that over the course of 4 weeks, this stock should only move about 2%. And I think it can move 4. This ETF can move 2 standard deviations. That's that once a month. Sorry, in terms of monthly moves, that's like once in 2 year kind of move for XLF. So if I have a once in 2 year kind of opportunity and I can buy these $38.50 calls, even if they cost 35 cents by the time we breach our breakout price. And if I think we can go to $41, they could be worth $2.50. Heck, if I had an asset that I thought could be worth $2.50, why wouldn't I even pay 50 cents? 50 cents to $2.50 is a 400% return. And frankly, they're probably going to be cheaper than 50 cents by the time I enter. This is the explosive setup we're seeing in the market right now. S&P 500, Brazil, widely driven by commodity prices rising. And again, financials are just primed to go. One of these three may do it. Maybe all three fade back and go back to support. But if even one of these three trades pays off, that's how I can grow my portfolio rapidly. So I'm going to be monitoring these three along with many others. A lot of them are individual names on my outlier watch list. I'll be looking for all of them and seeing which ones turn into that next explosive 400% or more trade, because I think the market right now is ready to give me that opportunity. If you have any other questions, please feel free to type them into the Q&A or the chat box now, or email me after, keith@optionhotline.com, or you can call me 312-600-8004. And again, keep an eye out for webinars at optionhotline.com if you want the free giveaway. That will be in your inbox tomorrow. For those attending, or watching after the fact, please definitely email me, keith@optionhotline.com, if you have any questions. So let's open up the room to the questions now. I do see one asking about weekly charts. So weekly charts are a very good tool for the trend trading portfolio. Today, I'm looking at swing trading more than that, and that gets me down to like days or even hourly charts or even less. So weekly charts, the way that I tend to look at my charts is that I want to time the timing of my chart to match the time of my trade. So if I'm looking at a trade for a matter of days or weeks, I want to be on a daily or shorter time frame on my chart. If I'm looking at a trade for months, which I often do for my trend trading portfolio, then I can look at a weekly chart. Anything else that you
Keith, I do have access to several questions that you're not seeing right now, only because of your presentation being up. But so I've got at least 4 questions right here that have come in. The first one says, or the first one is that about, once again, sample portfolios. Many of the attendees know that all of our authors have sample portfolios that they trade in and show. They're not actual dollars and cents, they are samples. But could you tell us how far up your sample portfolio is for 2021 so far?
Yeah. So for the portfolios, I actually don't have the 2021 numbers in front of me. I will have to get that back to you, but I know for 2020, the trend trading portfolio was up 147.4%. And the swing trading portfolio, I got to double check that one again as well. Hopefully I can get that to you very quickly here.
Okay, if not, I can go on to the next
Yeah,
question.
no, if you don't mind starting the next one, I'll log into our systems here so I can take a quick look. But
sure.
I can tell you our swing trading portfolio last year, I actually did just get it, was up just under 80% last year.
Wow.
Oh, great. Sorry, just under. I'm sorry, that was I looked at the wrong number. Just under 40% last year. So last year had fewer swing trading opportunities, more trend trading opportunities. This year, I think we have more swing trading opportunities and less trend trading opportunities, which is why I'm doing this webinar we're talking about right now. So yeah, again, 147.4 for the trend and just about 40% for the swing, which still better than the market, I guess, right?
Absolutely. So, well, that's great. Thank you. Thank you for that. Another question here, and one close to my heart, being a political junkie that I am. How is your trading affected by the ever-changing federal government?
Little. How about that? So I try to put everything down to the technicals and the charts because for those of you that watched even a couple weeks ago, Apple stock had great earnings and the stock has done nothing since. It's been down. Qualcomm, another example of a stock that had great earnings and it's been down. Oftentimes that fundamental is already priced in. So I think people are always trying to speculate on what the fundamental can or will do. And I agree with trying to have a perspective on that. But also understand that my personal expectation for a fundamental input is likely to be less, deep of an analysis than somebody from Goldman Sachs, who that's all he does for a living. I'm trying to analyze and trade, and I can do that better with math than I can with reading 10,000 pages of an earnings report, right? So right. I think that in general, while I think that certain things like oil prices can and probably will go higher, and this is based upon stuff that I've done, with the hedge fund in the past, or the fact that I think that tech companies will still probably thrive whether we have a COVID environment or not. I try to put those to the back of my mind and just say, look, those are just minor inputs relative to the technicals.
Gotcha. So if I'm interpreting that correctly, what you're saying is you keep less of an eye on moves by the federal government and a lot closer eye on your math and your option trading checklist and the technicals that you use as opposed to
Absolutely,
watching.
Yeah. I need to know timing on those announcements more than I need to know the actual specifics, because if I know an announcement's coming, that can cause a stock move. But if I don't know enough about what that actual announcement's going to be, then I just more need to know that it's coming.
Right. Understood. Okay. Yeah, because it creates some movement. Sort of creates movement. So, okay. Another one that I have here is from Pauline, and Pauline is asking, would you please just repeat the difference that you discussed before between trend trading and swing trading?
Absolutely. Yeah. So a trend trade is something that I'm expecting to play out over the course of months or even years. I think our longest held position in our trend trading portfolio is over a year at this point, which is just something that you expect long-term growth. Swing trades, I'm looking for quick, aggressive moves. If a trend trading stock that I'm bullish on has an aggressive move to the upside, that's nice. It's a nice little kicker to my move. It just means I got some more of the momentum earlier on than I expected. But it's kind of that idea of, you're just slowly filling the coffee pot versus dumping all the water into the coffee pot at once. So I'm trying to get that move over time, expecting it to take months or maybe even years. Still leverage, still good, just a little bit of a slower move, either both for the returns as well as for the risk. So the risk usually takes longer to kick in as well. So
Gotcha. Go ahead.
it tends to sort of be a preferred method of trading for a lot of people because it can be smaller losses and smaller gains every day, but you can just slowly see the portfolio growing. It's, building a house instead of just throwing a house into a lot,
Yeah, understood. Great. And Pauline actually follows on with one kind of a half a question saying it's the difference in the deltas that
Yeah. So
she's trying to understand.
So like a 70 delta option, my trend trading type portfolio, what that really means is that a delta can be viewed as a stock equivalency. So if it's 70 delta, it means my call represents something similar to owning 70% of a share of stock, or 70 shares because each call represents normally 100 shares. So my day-to-day moves in a 70 delta option initially should act similarly to owning 70 shares of stock. My 30 delta call initially starts off acting like 30 shares of stock. If I get my explosive move, it quickly moves from being 30 delta to a higher delta, like 70, 80, or 90. And that's where I get my explosive return, is because my option that initially was supposed to only act like I owned a fraction of the shares turns into a full share, quickly giving me leverage, quickly giving me that major payout potential. That's why when options are cheap and I can buy 5 out of the money calls, that can create major leverage, because even though right now 530 delta calls acts like 150 shares of stock, as it goes higher, it starts acting more like 200, 300, 400, or even 500 shares of stock. So it acts like more stock as I'm proven right, which gives me leverage.
Great answer. Thank you. Hopefully, Pauline, that was 2 very good answers. Actually, Pauline mentioned again, thank you. I believe that you can offset a long-term trade with a spread.
Yeah, absolutely. Spreads are a great way to offset long-term trades. Part of the reason I don't like to get too much into that on these webinars is just because we're limited on time. So that's something,
Right.
actually, if you want to talk about more, definitely feel free to email me. We can also set up one-on-one sessions if you want to sort of fine-tune the way that you trade your long-term positions.
Yes, and Pauline, those are that you can look those one-on-one sessions up in our store under Keith's products, and I'll let you take a look at that. The next one, I do not have a first name, but the last name is Markham. So Mr. or Ms. Markham asks, how do you protect yourself from the downside on swing trades? How do you find the one standard deviation?
So the first one's easier. Part of the question is easier than the second part. The first part of the question, how do I protect myself from the downside? Most of that is actually cash management and understanding position sizing. If I get an abrupt move against me on a swing trade, I might lose close to 100% of that initial premium I put in. So if my risk tolerance is $1,000, I cannot buy more than $1,000 worth of calls. Because if I buy $2,000 worth of calls expecting to get out when they're only worth $1,000, I'm going to be kicking myself 9 times out of 10. Again, I'm in a situation where I don't think we're going to stay here. I think we're either going to go way up or a little down. But just a little down can hurt a lot on out of the money call options. So for this, it's more about just initial position sizing. Calculating the one standard deviation, there is a formula to it. I can try to explain. Best to email me on that, only because the calculation gets a little bit convoluted, and I think most people would probably fall asleep as we try to talk through it here, because it would take me a few minutes. So if you want to email me after, I can talk you through the one standard deviation calculation.
Great, and thank you. And just to let everyone know, this webinar has been recorded and will be posted in the archives of the option Hotline website. So please feel free to jump on the Option Hotline website tomorrow. Should be up there tomorrow. The full recording of this webinar. So Keith, just have one more very broad question for you, and then if nothing else comes in, I can let you go and do another quick webinar to another quick website tour of the Option Hotline website. But so this broadly is any major investing themes that you see coming up in Q3?
So I think that well, two of them I kind of touched on today as I think initial. So a lot of times those swing trades are actually the start of a trend trade. So if those swing trades play out, financials and commodity related companies, I think, can still really do well. I'm not necessarily sure I would bet on gold and silver type related commodities, but I'm thinking more in the terms of like oil. So that's where Brazil can kick in some. Commodities just on the whole seem to want to continue to firm under a Democratic presidency. So kind of going back to that first question, commodities were weak for 4 years. Now seems to be a time where they seem to be firm. So if commodities can stay firm, particularly the oils and the base metals, that can create some major opportunities in sectors like Brazil, as well as the base metal companies that are here. But I still think financials, again, another good one, especially as interest rates continue to rise, which they just seem to be on a one-way track there. I mean, that's a thematic trend that's been existing for a while. Even if interest rates have fallen a little over the last week, it's hard to bet against that when we're, kind of moving back into a quote-unquote normal operating economy, hopefully, with a vaccine and moving away from the COVID economy. So,
right, and certainly being talked about a lot.
Yeah, exactly.
That's for sure. So if you watch the news a lot, it's being talked about a lot. So Keith, I think that is it for our questions. I don't see any new questions that have come in. You are more than welcome to stick around for the website tour, but I know you've seen it quite a few times in and out and in and out. So either way, I'm sure I speak for our many participants in thanking you for a great webinar today. And we appreciate it very much. So stick around if you wish, take off if you wish, but I will take the screen back and we will do a bit of a Option Hotline website tour. So thanks again, Keith.
Thank you again, Steve. Have a great website tour here, folks.
Thanks very much. Take care.
Thank you.
Okay, so I'm going to take the screen share back and going to jump in here. Just 1 second. Once again, this was Keith, and I'm going to pause that share for 1 second and resume the share. And we thank you all very much for joining us. And here we are on the Option Hotline website. And I'm just going to cover 3 of the tabs here. We talked a lot about Keith's products. And if you take a look at Option Hotline, and again, if you look at the logo here on Option Hotline, that always brings you back to the home. But under memberships is where all of our products are, and especially Keith's products. And you can see highlighted is Keith's 5 indicators for trading success. We have talked about that a lot today. We also talked about his option trading checklist product. So feel free to take a look at all of Keith's products here, all of the Option Hotline products here, all of our subscription products here. So we have a wide variety of products. Some of them are no charge, and the ones that are a charge are priced very well, and we hope you'll take a look at all of them. And once again, we are going to be sending you the option trading checklist over email, and so you'll be getting that tomorrow. Under our About tab, coming up in 1 second here. This is a little bit more about Option Hotline, our website and our business here. We hope that you will join Option Hotline as a member to develop your skill set and trade like the pros. This is our mission statement and our values statement. I'll pause for 1 second so you can just quickly read those a little bit. And again, importantly, we're an unbiased source of research and professional options strategies. We have a great stable of commentators, authors, as I refer to them. Keith is on the far left here. We also have Dr. Duke, Dr. Carrie Given, Dr. Duke. Chuck Hughes, very well-known author, and is on television and on different broadcasts quite a bit. Dan Passarelli, market research expert, and we also have Steve Kalasian and Don Fishbeck. We also are going to be having several new commentators, authors joining us very soon. And so we hope that you have enjoyed today's presentation by Keith. I'm going to continue the website tour here, but once again, we hope that you have enjoyed Keith's presentation today. So if you're looking for winning ideas, just click on this Get Started button. So going all the way back to the top here, for those that are members with us, we have a special member login. And for those who are not members, you can contact us anytime, and you can ask about membership or any of our products. And we show you real news leading to real profits. Trade alerts, podcasts, webinars, and online courses. That's our basic 1, 2, 3, 4 punch. And we offer all of those on a regular basis. And we are here when you need us. Under customer support, email us at support@optionhotline.com. Subscribers can ask about any adjustments you might need in your accounts and your subscriptions, but please feel free to call us or email us. Customer support, anytime 9 to 5, email us, support@optionhotline.com. In sales, we invite you to look at all of our products as well as our memberships, and reach out to us, info@Option Hotline, anytime if you have any questions about our subscriptions, about our products, and especially about any products from Keith Harwood or Dr. Duke, Dr. Carrie Given. info@marketeducation.net is our sales arm. You can reach Market Education at 312-858-9009. That is just for products from Keith Harwood or Dr. Carrie Given. If you have any trade alert questions, we issue trade alerts. Please email Keith directly, keith@optionhotline.com. We mentioned that during the presentation today, keith@optionhotline.com. And he looks forward to your emails. Also, we have podcasts and our webinars, of course. And if you have any questions about any of our current or past webinars, we invite you to email us at webinars@optionhotline.com. We also have podcasts. So we man this webinars@Option Hotline email, certainly Monday through Friday, 9 to 5, but we generally get back to you much more quickly anytime during that time frame, but we are also on that usually more than the 9 to 5 hours, and we can get back to you very quickly there. So going back up to the top once again. So we went through our About tab, we went through our Contact tab, and I'm just going to quickly go through the Webinars tab once again today's webinar was by Keith, but we do have webinars from our other authors as well. How to use the current market setup to generate 400+% returns. And we do have a webinar coming up the 23rd of June, simple trick to improve your trading odds. We always have at least one more webinar listed under our webinars. Sometimes we have as many as 2 or 3 more. And this is Keith's webinar today, which will be in the archives as of tomorrow. And then all of our webinar replays are presented. Dr. Carrie Gibbon, you see on the left, Keith again. We sometimes have celebrity guests joining us like Ayadami. And so we invite you to take a look at all of our past webinars. We got a lot of them up there. Quite a few pages of past webinars. So feel free to jump in there, take a look at anything that floats your boat, and we hope that you will enjoy that. Also, you saw Keith's disclosure and disclaimer. So please remember that we showed you that disclaimer during our webinar today. And once again, the title, Current Setups to Generate 400+% Returns. All of you will be receiving the option trading checklist tomorrow in your email. And also, just one other quick thing here under contact, just want to mention that we do have under our contact tab a way for you to whitelist Option Hotline and a way for you to reach out to any of our commentators. But if you're having any difficulty receiving our emails or our trade alerts, go to whitelist at Option Hotline emails or download the Option Hotline contact card. Either of these will help you stay in contact with us on a permanent basis. So if you're having any difficulty, be sure you look at the whitelist Option Hotline emails so you'll be assured to always receive our emails. And then you can also download our contact card anytime so that you have it right at your fingertips to download the Option Hotline contact card so that you can reach us anytime. Keith and all of our authors love hearing from traders like you. As Keith mentioned, especially retail traders. You can reach out to any of our commentators here, Carrie, Dan, Don, or Steve. So please feel free to reach out to any of them. You can reach them all by first name and then optionhotline.com. So we went through that we're here, and we hope that you will contact us anytime. So that is basically about it for our webinar today. And just want to do one more quick share here. Sorry. Okay, so we're just about done here, basically. And we thank all of you for participating today, for attending today, and thank you very much for joining us. We do have another webinar coming up, and keep coming back to the Option Hotline website that you see here to look at our calendar for upcoming webinars and many additional excellent products that you can purchase or receive for free. So thank you very much for joining us. We appreciate it. And we are done for today. Thank you.